What is a cash ISA allowance? The cash ISA allowance is part of a greater set of regulations over a certain kind of savings account in the United Kingdom, which is called an individual saving account. The cash ISA allowance is the maximum amount of cash that can be deposited into the account in a single tax year. Along with this limit, there is also a maximum for amounts of shares or stock that can be deposited. The ISA can include cash, stock, or both. The ISA allows for different taxation of assets, including both cash and equities. This UK provision helps those with available capital to plan for long-term savings or investment. In the UK, the ISA basically cuts down on taxable savings. Every country in the world has its own rules for taxing income and capital gains, as well as some other kinds of revenue to individuals or households. The way that a national government treats tax-deferred or tax-exempt savings reflects on its overall financial policy. For example, in the United States, tax-deferred savings accounts are promoted as retirement accounts, including the conventional individual retirement account or IRA and alternatives like a Roth IRA. When a UK citizen uses a cash ISA allowance, they must limit their deposited money to the maximum amount. Experts contend that government officials often use a standard calendar of April to April for limiting ISA contributions. This allows for enforcing the maximum cash value that gets added to tax-exempt accounts. Although many citizens in the United Kingdom might take advantage of an ISA to avoid some kinds of taxation, eventual withdrawal of the money can be difficult. Finance professionals in that country warn that some kinds of withdrawals can carry heavy penalties. Taxes can be assessed retroactively for money that is taken out of the account in an improper way. Many other countries also practice this quid pro quo when it comes to tax deferments or exemptions for long-term savings. Individuals who look at the way the United Kingdom uses the cash ISA allowance and other rules on ISAs can compare this with savings and investment rules in their own countries. Governments around the world are considering how to grow revenues without harming the ability of families to save for the future and stabilize their income and assets to provide a better life for their children. Another key item in this equation is how the governments of respective countries allow individuals to pass on assets to their offspring or other beneficiaries.